Many people are confused about where they should invest, whether in equity mutual funds or debt mutual funds. Because of this confusion, they often end up delaying or taking the wrong decision. So, to bring the clarity, I have covered few important points that will help you decide correctly. Hi, my name is Swapnil, and in this video, we will clearly understand the difference between these two types of mutual funds. Now, let us have a look at first type of mutual fund, and that is what is an equity mutual fund. When you invest in an equity mutual fund, your money is used to buy small portions of different companies. In simple words, equity funds focus on growth, but that growth comes with some ups and downs of the market. Here are three important things you should know before you invest in equity mutual funds. First, high return potential. Equity invests in growing companies so the returns can be higher over a long periods. Second, market ups and downs in the short term. Equity prices fluctuate daily due to the market movements. And third point, suitable for long term goals like retirement, child education, wealth creation. Time helps average out volatility and build wealth. A simple example of equity mutual fund is as the company grows, their investment value increases over the period of time, and hence you can get good returns in the long term. Now, let us have a look at second type of mutual fund, and that is debt mutual fund. Debt mutual funds invest in fixed income instruments like government bonds and corporate bonds. In simple words, debt funds focus on safety and stability. They may not grow very fast, but they help protect your money. Here are three key things you should know while investing in debt mutual funds. First, low risk compared to equity. Debt funds are not affected by the stock market volatility. Second, more stable returns. Returns are relatively predictable compared to equity. And third, suitable for short to medium term goals, ideal when money is needed in the near future. Now let us have a look at simple example. You earn interest on your money similar to an FD but with better flexibility. Now, the obvious question that comes to our mind is that which mutual fund type we should choose. And for that reason, we will see this choosing the right option. The first is goal more than 5 years away, we should go for equity mutual funds. Longer the time horizon for your goal, the volatility gets reduced, and hence the chances of getting higher returns because of investment in equity mutual funds will be very high. Second, goals within 1 to 3 years, we should prefer the debt mutual funds. Now, the debt mutual fund keeps your money safer when the goal is close. And the third option is want a balance. In this, there is a combination of both the types of mutual funds, and this should always be preferred majority of the times. This helps to manage the risk while still aiming for the growth. Now, let us compare these two types of mutual funds. First, equity mutual funds. Equity mutual funds is equal to higher growth plus higher volatility. Your money grows by participating in company growth, but the values can move up and down in short term as the market fluctuates. Second, debt mutual funds. Debt mutual funds is equal to stability plus lower risk. Your money is invested in the interest paying instruments aiming for the safety and steady returns. Now, the important reminder from this video. Equity helps beat inflation in long term by delivering growth higher than the rising cost. And debt helps to protect the capital in the short term by reducing the exposure to stock market swings. Now, the closing message. The right investment is not about choosing the equity or debt. It is about choosing the right mix based on your goals and time horizon. If this video gave you clarity, don't keep it to yourself. Like this video and share it with someone who is still confused about where to invest. Subscribe to the channel for simple and practical financial guidance. This is Swapnil from Sriram Investments, helping you make better financial decisions. And in the next video, we will go one step deeper. How much should you invest in equity and how much in debt based on your age, income, and goals? That will help you build the right asset allocation strategy.